You know what? I haven't got a problem with the rain here in Singapore because I'm enjoying myself so much that I feel like a sandboy, just sort of sitting there and just enjoying all this rain.
Okay, and he was kindly driven by a very good friend, Ken Chee. He is, of course, the founder and the CEO of 8 Investment. So, David, let's get this out of the way. What, for the sake of my own edification, what is the fiscal cliff? We keep being told that the Bush tax cuts are going to expire, and what does all of this mean?
Well, essentially what it means is that the U.S. government can no longer borrow any more money. The U.S. government has already borrowed $16 trillion US. I mean, that's a phenomenal amount of money. And essentially what they're saying is that you cannot keep on borrowing money because who is going to be lending you this money? And if you can't borrow the money, you have to try and sort of live within your means. It's a very simple thing. It's a bit like all of us. I mean, if we start running up credit card debts, eventually the banks will say, look, enough is enough. I'm not going to let you have any more credit. You have to start paying that back.
Or make you a bankrupt.
Or make you bankrupt. That is a very good point because there are only 3 ways in which you can sort out debt. You can either pay it down, and in the case of America, they have no ability to pay it down. You can service it, right? Or you can inflate it away. And what they're doing in America is just trying to inflate away that debt right now. There is a 4th way, which is the default, which is what you said about sort of going bankrupt. So there aren't many options left to America. They can't default because that would then give it no credibility at all. They can't pay it down. So what they're doing in America, and also what they're doing in Europe and the UK, is to inflate away the debt. And it's a very sneaky way in which they do it. It's what we call financial repression. You don't really notice it. But what happens is that if you have $16 trillion US worth of debt, if you can create some inflation, say 5%, $16 trillion will not feel like $16 trillion after about a year because inflation will just inflate it away. So it's a bit like you and I. If we have $100 today and we don't do anything with it, well, at 5% inflation, the $100 will only be worth $95. That is how it works. And this is what they're trying to do in Europe because they know they can't default. They know they can't pay it down. So therefore, let's go down this road of financial repression. Let's go down this road where we can just maybe hoodwink people, not tell them what we're actually doing, but inflating away that debt. It's a very, very dangerous thing.
Before we ask you about the pitfalls of what they're doing, what does all of this mean? Is the fiscal cliff a reality, or are they going to do what they did during the Y2K, make a big huff and puff about it all, and then it will just come to naught? We will have a consensus. We will push, or rather kick the can further down the road.
Oh, yeah, they're kicking the can further down the road. There's absolutely no doubt about that whatsoever. What is really happening in America is that there will be a bit of saber rattling. The Republicans will rattle their saber a bit and sort of say, no, you can't go and borrow any more money. And the Democrats, on the other hand, say, okay, I'll tell you what, we'll raise some taxes. The Republicans say you can't do that. But guess what happens right at the very end? They will just borrow more money again. That $16 trillion will turn into $17 trillion. And probably within the term of this presidency, it will become $20 trillion. I mean, that is really scary, isn't it? To actually owe somebody $20 trillion. But they have no option. What else are they going to do? So Ben Bernanke will just keep on printing more money. He's already said that. He said that I will continue to pump money into the economy until such time that the U.S. economy starts to grow. Well, it's only growing at about 3% at the moment, which is not enough for a country that size. So he'll just keep on printing and pumping. And who's going to pay for it? The American people will pay for it. And what is even more scary is that we will pay for it here in Singapore.
Okay, and how will we pay for it?
Well, it will create inflation. It is hugely inflationary because as the US dollar falls, commodity prices rise. Because if I was a oil producer, what I will say is previously I could get $100 for a barrel of oil. That's great. Mm-hmm. But $100 may not actually buy me $100 worth of stuff anymore. So what I need to do is to put my $100 a barrel of oil up to $110 a barrel, because then I can afford to go into a restaurant, makan, and go and eat some stuff, and then I'll be happy again. Because it is inflationary. So what is happening is that as the US dollar falls, and the reason why the US dollar will fall is because they're just creating more of it. If you start printing more money, it is going to be worth less. Not worthless, but it'll be worth less. And as it gets to worth less, as it becomes more and more worthless, then, of course, inflation will start to rise. And that is one of the reasons why people say, let's go for gold, because, gold is a safe asset. But personally, I'm not a big fan of gold. really, I am not a big fan of gold at all.
Okay, but everyone seems to be wanting the precious metals these days, or finding some form of exotic form of investment other than, putting in the market and watching the kind of hurly-burly that's been going on last week and the volatility that has been affecting us, well, basically for the whole year.
What? And like gold isn't volatile, Keith? I mean,
I'm sure it is, yes.
No, if I give you a lump of gold now, right, and you sit it on that desk, not that I'm going to give you a lump of gold, but let's say I give you
I'm hoping, we can always hope.
Let's say I give you a lump of gold, right, a bar of gold, we sit it on that desk. What does it do, Keith? What does it do?
Paperweight.
It does absolutely nothing, right? It just sits there. I might as well give you a piece of plasticine and sit it on there because it doesn't do anything. It doesn't generate an income for you. All that happens is that it goes up and down in price. It's a bit like if I just give you a pogo stick. All you do is you just jump up and down all day long, and that is what happens to gold. It doesn't do anything for you. So what we're saying to people is if you want to invest, then you go and invest in assets that will generate a revenue for you, generate an income for you. And this is where shares are. And also, I mean, at the same time, I shouldn't poo-poo the idea of property, because property does something very similar, because property does generate an income. But the difference between property and shares is, Keith, if I went and bought a piece of property, I either sell the whole property or none of it at all. I cannot sell my house, my flat, my condo, brick by brick, right?
We would like to, but unfortunately
you can't do it. But whereas with shares, I can sell half, I can sell a quarter, I can sell whatever I want of my holdings, and that is the beauty of shares over property. Earlier on I said that the big problem is inflation, which therefore means that people, consumers, investors need to ensure that whatever money they have is going to keep pace or be better than inflation rates. So you have to ensure that, there's no point having 100,000, putting it in the bank and saying, oh, at least I have 100,000. Inflation will just eat away at it. So you have to make sure that whatever you have is going to keep pace with inflation, because otherwise you're just going to end up with less and less, which therefore means that you need to invest in inflation-beating assets. And there are only two that I know of. There are only two inflation-beating assets. One is property, the other is shares.
Yes.
Yeah. There's a total of 4 assets altogether. There is bonds, cash, properties, and shares, right? And the two that I'm interested in is property, because I have to live somewhere, but the other one is shares. So what you need to do is to focus on buying shares, good quality shares that you can hold for the long term. Buy into companies that can pay you a dividend, and make sure that the dividend, which is a share of the profits of the companies you're investing in, and make sure that the dividends are going to be increasing over time. It's going to be increasing at a rate that is faster than the rate of inflation. And there are lots of companies out there, which is what I specialize in doing. I specialize in looking for companies like that.
Okay, give us a hint then. Just scrape the surface for us.
Okay.
Okay.
Right, you want a share tip?
Okay, no, well, okay. Okay, and of course...
I didn't realize I was brought here for share tips.
At this particular point in time, before David says anything, I think it's best to say that the views expressed on our program are that of our guests.
Yes.
And if you feel the need to act on any of it, please contact your financial advisors. David, go ahead.
Okay, I'll give it to you as broad as possible, right? You want to look for a company that can raise prices without the consumers even noticing, or without the consumers even caring. So let's take, for instance, a company that I own shares in. It's a UK company. It's called Burberry. Mm-hmm. Now, I can see you are a man of great tastes. So therefore, you might be somebody who buys Burberry. Now, if you buy Burberry, do you care whether or not it is going to cost you $1,000 or $1,100? Probably not. So Burberry has what we call pricing power, because it is catering for that top end of the market. That top end of the market is not price sensitive. So whether something is expensive or cheap isn't going to deter them from buying. So that is a company with pricing power.
Okay.
Another one would be a company like Coca-Cola, which I don't own shares in. Now, Coca-Cola can increase its price. Now, how much does a can of Coke cost here in Singapore?
On the average, I think about $1.50.
Okay, other soft drinks are available, but we'll take Coca-Cola as an example. Now, if Coca-Cola were to put the price of its drinks up from $1.50 to $1.65, would you notice? Would anybody care?
10% increase?
10% increase, right. If inflation is running at 5% and the company puts the prices up 10%, it's going to be making more money. So That's another example of a company that has pricing power. It can put the prices up without people noticing. Now, here's another company that I own shares in. It's called GlaxoSmithKline, and they make pharmaceuticals. Yeah, they make drugs, legal drugs. Now, in the case of GlaxoSmithKline, if they are making a pharmaceutical product that you need, and they put up the price of that product that you need to buy, are you going to quibble over whether or not they put it up 10%? No, you don't. So those are examples of companies that you can look for in the stock market where they have pricing power. And they can increase the price above the rate of inflation, maintain its profits in order to share out the dividends, share out the dividends to investors. So as an investor yourself, you will benefit from it.
So it's basically looking for value in the companies that you are investing in.
Absolutely.
And don't look for the minor or the major volatility and I tear my hair out at the end of the day.
Right. You see, you mentioned volatility, which is a very interesting concept. Let's say, for instance, that I buy a share, right? And this share is worth $1 a share. So have that figure in your mind, $1 a share. And it is paying out 5 cents in dividends, right? So the yield on that share is 5%. In other words, if I took $1 and I put it in the bank and it was paying me interest at 5%,
I hope it's less than 1% over here these days. Okay, well,
I know, which is why I'm saying that we should be looking at shares. So if it pays you 5 cents a year, that's a 5% yield, right? Now let's say that today the share price falls from $1 to 80 cents. What is your dividend that you're going to be getting from that share? It is still 5 cents. So the share price becomes completely irrelevant to what you're going to be getting as an income from that share. So the share price can go up and down as much as it wants, but as far as you are concerned, you are earning 5 cents every year. And if anything, you would want the share price to fall rather than to rise. Because if the share price falls, what happens? You can buy more. And that is the beauty of investing for income, because the share price then becomes completely irrelevant the moment you've actually bought the shares.
669-11938 is the number. We're coming into the final stretch of MoneyWise on 938 Live. If you have a question for David, now's the time to do it. MoneyWise will continue in just a moment.
MoneyWise with Keith D'Souza on 938 Live.
The Asia Pacific Food Expo is back. From your favorite snacks, health supplements, to ready-to-eat cuisine, a wine pavilion set up to entice your nose and taste buds, and new product launches. Join me, Janice Teo, on All About Food to find out more. Monday to Friday, 11:45 a.m., 12:45 p.m. and 1:45 p.m. on 938 Live. The Asia Pacific Food Expo 2012 is brought to you by the Singapore Food Manufacturers Association.
We're back. In the month of November, Body and Soul brings you another exclusive health seminar. Look good, feel good, see better, which encompasses 3 main areas. Look good. Find out about the latest in eyelid surgery, rethinking eye bag surgery, and drooping eyelids. Feel good. We tackle the issue of obesity and metabolic wellness. See better. LASIK and other eye health concerns discussed by our ophthalmologists. Diabetic retinopathy, glaucoma, cataract, and more. Join us on Saturday, 17th November at Mount Elizabeth Novena Hospital. Tickets are going at only $10 per person, not including ticketing fee. To get your tickets, call now 6296-2929. Details at cinemasend.com/938live. This message is brought to you by Mount Elizabeth Novena Hospital.
And now, the LTA traffic news.
Clementi Road towards West Coast Road, junction with Sunset Way. Clementi Road towards West Coast Road. The Sunset Way is the sort of place where, you need to be able to see what's happening and coming at you before you make that turn. In this weather, we would not advise it. Take the U-turn further up the street. The PRE towards Jurong before Engyo Avenue, and that problem with Lornie Road, now all of it has now moved back towards Farrer and even into that tunnel at some stage because of an accident, and because it's taken 3 or 4 hours to sort out. We suspect it's been very, very serious. At least 2 lanes are obscured currently. 2 vehicles broke down, one AYE towards the ECP after Lower Delta Road exit, and the KPE towards the ECP before Nickel Highway exit. Avoid lane 2.
Here's a message from the LTA.
Did you know that the Green Man Plus scheme allows the elderly and disabled more time for crossing at selected locations in Singapore? With the Green Man Plus, crossing will be much easier and safer.
The LTA traffic news is supported by King Coil. King Coil's best-selling microgel bedding collection features an anti-allergenic alternative to Goose Down. Silky smooth in texture, providing you the ultimate in comfort and support. Available in pillows, bolsters, quilts and mattress toppers in all departmental stores.
MoneyWise on 938 Live.
We're into the final stretch of MoneyWise on 938 Live. I'm Keith D'Souza and I'm joined by David Quor. He's a director at the Motely Fool, which is an online investing website. Of course, if you have a question for David, now's the time to do it. 669-11938. David, we were talking about value investing and looking for stocks that will outpace inflation. Will and I were having a little conversation earlier on. Is it really possible?
Well, of course it is. I mean, all you have to do is to look at the stock market. There are so many companies out there, so many great companies. But the most important thing is to buy them at the right price. Because what you don't want to do is to overpay for something. Because then it will damage the returns that you get. So
don't be lemmings.
Well, don't be lemmings. But also at the same time, I mean, the great analogy with lemmings is that what we're going to see over the next maybe year or so is a lot of volatility in the market. So what I have is a list of shares that I would like to buy. It's a bit like, somebody, you are a person who I presume drives a car, right?
Yes.
Okay. Okay. I don't know whether or not you have a Ferrari, but would you like to drive?
No. I would like to drive a Ferrari.
Okay. But would you like to drive? Yeah, you would. Yeah.
Yeah.
So what you do is you put your Ferrari on your watch list, on your wish list of things that you would like to own. And then one day somebody comes and sells you a Ferrari for the price of a Volkswagen, right? Would you buy it?
Yes, I would, actually.
Well, of course you would. And that is the whole point about the stock market, because the stock market is driven by fear and greed. And when it's greedy, the prices are very high. When it's very fearful, when we're talking about the fiscal cliff, people get worried, so the prices fall. But you know what the value of the shares that you want to buy are. You know what the value of a Ferrari is. So when it falls to the price of a Volkswagen, what you do is you go, right, okay, I'm ready to buy. And then you start buying the Ferrari. And the next time I see you, Keith, you'll be driving around town in a Ferrari.
We're in gridlock, but maybe. So, okay, for the man in the street, we should be looking for value. You were talking a lot about European stocks.
Yeah.
And with the European situation as well, not looking all that healthy, is it still a good time? Because like we said, the money is flowing into Asia.
Yeah.
So should we be looking at European stocks?
Well, what I tend to do when I look at European stocks is to try and find the ones with big exposure to Asia. So I'm looking at Burberry, which is exposed to Asia. I'm looking at Unilever, which has got great exposure to Asia. So most of the shares that I own do have some kind of exposure to Asia. And that is the kind of buffer that I'm getting in my portfolio. It insulates my portfolio, insulates my shares, because I know that the Europe is going to drag, but as far as Asia is concerned, the emerging markets, that is going to boom.
So let's bring it back. There's a lot of talk these days that, China's growth has dipped a couple of percentage points. You wanted to be 8% and now 7.5.
Big deal, Keith.
Okay. What does that mean, actually? Is it still going to be the driver of growth for the world?
Of course it is. I mean, it is going to slow from, say, 10% to 8%.
Okay.
Well, I think most people would take 8%. Right. I'd even take 7%. But what is happening in China is that it is going through a transition. China previously was reliant on exports. It was an export-led economy. But what is happening in China is that the middle classes are becoming wealthier. And so China will switch. And it is switching now, which is why people are a little bit afraid. Because when you're at some kind of turning point, you don't know what's happening. But I think a lot of people that look at it from the outside can see that China is becoming consumer-led, which therefore means that the people are going to start spending money and buying goods. Now, the big thing is, are they going to buy Western-made goods, or are they going to buy locally made goods? And we saw recently the Lenovo, the big computer company that used to be IBM. Yeah. It is now one of the biggest computer makers in the world. Who is buying it? Primarily Chinese consumers. So therefore, we're actually sort of seeing this shift that the Chinese people are going to be buying locally made goods. So now's the time to start looking at Chinese companies, good Chinese companies that you would like to own, because I think the prices are going to be quite reasonable.
And before we go, we have to ask about this debacle between the U.S. and China. Every so often, it rears their ugly head. Is it rhetoric?
Some of it is rhetoric, Keith. I think what is really happening between China and America is that China needs America, America needs China. It's what we call a symbiotic relationship. It's a bit like you and your relationship with your wife. The two of you need each other. You might argue every now and again, but you still need each other. And in the case of China, it knows it needs America, which is why it's quite happy to lend money to America so that America can then go and buy goods from China. This is what is happening. And so they both need each other, even though sometimes they might not like each other that much.